All right. Well, let's get started. This is our official start. We did a really soft start just now, right? But this is the official start. We'll get going. For everybody listening, we're happy to have you on. This is Capita's quarterly market calls. We brought on Tim Holland and Ryan Dressel. They're both from Orion. Orion purchased Town Square Capital, and Tim Holland has taken over for Kurt Brown while Kurt is now out on a mission. And Ryan it feels like, I mean, you can describe this better, but Ryan is kind of a package deal. Both of you bring a lot of experience, but it seems like Ryan, you've brought more of like the back end research and tech, like technology experience along the way as well. And I've asked Ryan to do little projects here and there for Capita, like, hey, can you give us some more color on cyclical stocks in this way? And sure enough, within hours, Ryan is sending me a lot of more information than I wanted, but it's wonderful, so I can then pick through what I need and what I want. And he gives charts and other things. I'm excited about this presentation. Looking through the deck, I think our clients will really like it. Just to give you a recap, last quarter, we did this a little bit different, and we spent a lot more time on how we manage your portfolio specifically. The quarter before was more like today, where we talked more about markets. So just so you get a feel for what to expect today will be a lot more on the economy, mostly macroeconomic picture, past, current, and what to look forward to. Whereas we're probably not going to talk much about portfolio design today. We've done that a couple times in recent educational webinars. Excited to have Tim and Ryan with us. I think the format that we'll take for this is we will have Tim and Ryan really run the show, and I will watch all of the chat and the Q&A. If you joined us in the past, you know that if you ask a question that goes along, especially with what we're currently covering, we're going to try to tackle that right away. If you ask a question that goes along with a future topic, I'll try to respond back to you and let you know, hey, we're going to hit that in a minute. And if you ask a question that's completely unrelated, we'll either try to slot it in, or I will, or one of our advisors will help afterwards. And so in other words, don't feel shy. In fact, the more that you all engage with us, usually I find the better these meetings go. We prefer not to just talk at you for the next 45 minutes or so. We've told Tim and Ryan to give us about 40 minutes of content so that we can allow for time and engagement and questions as they come through. So again, I'll watch all of that. Just a little bit of an update. Capita doing well. I just recorded a video of all of the things you need to know about the TD Ameritrade and Schwab merger and timeframes for when you need to set up a login. The reality is, I think we've gotten a few more questions recently about this because people have become a little bit more concerned because TD and Schwab are starting to send you notifications. We have used both of these firms for years, and we're very comfortable with both of these firms. We like both of them. They're both low-cost options within the broker space. They both have really low transaction costs to typically zero on the trading fees. And the technology we think is probably a little bit better with Schwab. We think our back-end servicing rep that you guys don't talk to, but like our back-end servicing experience from Capita relationship with TD is a little bit better maybe with TD, but we're hoping that continues over to Schwab as well as we get to know them a little bit more. But the bottom line is we've worked with both firms for years. It sounds like a really big deal, but the two firms were the most similar in the industry already. I can see why they merged in the first place. I don't think it'll impact you too much, but we're here to help you. We're watching it very carefully. And the main thing to know is 31 days before Labor Day, which is the weekend during which they will transition all TD Ameritrade accounts to Schwab. That's when you can finally set up a login at Schwab. If you're already using Schwab through us, your login stays the same. If you're already using TD Ameritrade through us, then you'll be given an option to use your advisor client login at Schwab as well. But frankly, most of our clients don't log into either. They just log into our portals to see it. And our portal feeds through to Orion, which is the company that Ryan and Tim work for. And they have a really nice performance reporting portal, which also, by the way, that is getting a facelift. And the Orion portal for clients will change within the next 6 months to a year and have a lot of functionality. There are a couple things that we want to see different within that portal. And so at Capita, we've kind of drug our feet a little bit and said, let's keep the classic view a little bit longer until these 2 or 3 things change, and then we'll help transition over. Anyway, those are more like things you need to know. If you're here on this call, you're getting that as a sneak peek, but we will send out an email with a link to frequently asked questions. And we'll send out in that email the video that I've recorded to help you know, like the key points about the Schwab purchasing TD Ameritrade. Okay, that was a lot, but we've had some recent questions, so I was hoping to just kind of tackle that and get that out of the way. Tim and Ryan, I feel like you guys can take it away from here. I'm really excited about what you guys have presented. I've been looking it over. I think our clients are going to love it, and I say go for it.
All right, thank you, Zach, and thanks for everyone on the call for your time today. I'm Tim Holland, to Zach's introductory comments, Chief Investment Officer of Town Square, or Orion OCIO, and Ryan and I have worked closely together under the Orion and Town Square umbrellas now for years. So we've got a presentation. Ryan's going to go first, spend 10 minutes or so just looking back on a very strong 6 months. I guess I previewed that earlier. And then I'll spend 25, 30 minutes or so thinking about the back half of the year as we're already into the second half. The calendar pages keep turning. Any questions or comments to Zach's earlier remarks? We'd love to do our best to respond, answer those questions. And the way we set up the presentation is really sort of a narrative, and then following those bullet points with economic and market graphs and charts that support the points we're trying to make. So again, thank you for your time. I'll step back. Ryan, you drive the bus, and when you're done with your part of the presentation, I'll go from there. But thank you all very much.
All right, sounds good, Tim. And to reiterate Tim's thoughts, thank you again for having me as well, Ryan Dressel, Senior Investment Strategist. So as Zach kind of pointed out in the intro there, think of me and Tim as a resource for any questions that might come up, especially after the presentation. Things might resonate as you start to read into the headlines in the news, and you might want to ping us or Zach, and we're happy to help out and add color wherever your question might arise. So without further ado, I'm going to spend the next 7 or so minutes looking back at the first 6 months of the year. So hopefully everybody can see the slides up now on the screen. All right, so the title of our presentation is called The 3 Key Questions for the Second Half, and is commercial real estate a shoe that is about to drop? So we have a lot of exciting things to get to. But first, I'll look back at the first 6 months of the year. And I met with Zach a few weeks back, and I brought up the fact that the S&P 500 was up double digits this year, and even more if you go back into the fall of 2022. And I kind of paraphrased that and saying I think that's a real surprise to most people. If you just read the headlines today, it's pretty negative out there, especially with the economic headwinds and news cycle that pertains to that. But for Wall Street risk assets and returns, it's been a pretty strong year. So if you just have one takeaway in this first bit here, just think of it, it's been a positive year, and we're pleasantly surprised. And that follows on the heels of 2022, which was a very, very difficult year for risk assets. So we had stocks down about 25% at their worst point in 2022, and to be up more than double digits so far this year is a welcome relief. And that also applies to fixed income investors as well, more conservative investors. The ag, the Bloomberg Barclays US Ag, which is a proxy for bond returns, had its worst year on record last year, and they're up a couple percent so far this year as well. So since the fall, actually, we started a new bull market, which can loosely be defined as a 20% run, either or 20% positive direction run for stocks. So we entered into a new bull market in June, and some of the positive catalysts for the stock market running up higher so far in the first half include better than expected earnings, and then that includes a lot of big high-tech growth and large cap companies doing very well, which I'll touch on in just a little bit. Economic headlines and data have come in a little bit better than what we expected, especially in the labor market. And again, we'll touch on that in more detail as well. The big one is probably inflation and the Federal Reserve's progress on mitigating and tamping and cooling down inflation down to more sizable, dosable levels. So in 2022, at its peak, we had a 9.2% annual inflation rate for the consumer price index. If you fast forward to today, that sits about 4% ahead of data that's going to come out tomorrow. That's meaningful progress, and that gives Wall Street and investors a lot of optimism as we head into the back half of the year, that the Fed will be a little bit more content with where we are in the rate hike cycle and look to end their hikes. Additionally, Seasonality has done really well. The political calendar is favorable with balance in DC and both parties holding a chamber of Congress. The banking crisis moved through just fine in March. We had a little bit of scare, but it was a hurdle we were able to clear. And then we got a debt ceiling, extending the ceiling for the debt for the U.S. government debt out into 2025. And then investor sentiment has really turned around as well, kind of taking a step back and looking at the picture and really kind of characterizing everything in a little bit more positive light and less doom and gloom that the sky is falling. We just switch over to the next slide here. So I mentioned growth stocks doing well. They've outperformed value sizably so far. They're up about 30% or so compared to single-digit returns for value stocks. A lot of that has to do with big mega cap tech stocks doing really well. In some cases, triple-digit returns for companies like NVIDIA, Tesla, Meta, which is Facebook's parent company, and more. So, some leadership has been pretty narrow so far, but it's starting to broaden out just a little bit more as other areas of the market start to participate in the recovery and the rally. Developed markets overseas have done well as well. Positive returns there, I think about 10% higher so far year to date for Europe and Japan. And then Japan specifically has benefited from improved corporate governance and greater inflation. So the cultural dynamic there has been a lot more shareholder friendly than it's ever been before in the last 30 or so years. And then finally, emerging markets have lagged as well, and that includes China. They've struggled with the reopening and bringing back capital and confidence in their markets since the reopening of their very strict lockdowns from COVID-19. Additionally, the property sector is also quite challenged as well. And then finally, the U.S. dollar has been a headwind for ex-U.S. stocks as companies transact in local revenues but have expenses in dollars. You want the dollar to do weaker if you're an overseas company. And just some visuals to support these conclusions that I'm sharing with you in the first half. So you can see the S&P 500 on the left chart, starting in January through the first 6 months, up about, like I said, 16% after clearing the banking crisis, which occurred in March and April. And then on the right, you can see international stocks showing a similar picture. Again, growth versus value, really sizable gap between growth and value. Bonds on the right, fixed income in positive territory, even with the rate hike picture unsettled and undetermined so far in 2023. China, as I mentioned, struggled, so they're only up about 4% compared to the S&P 500 here at home, up about 16%. So big gap there. And then I mentioned the dollar remaining strong. So, a lot of overseas economies are still grappling with inflation and having to deal with their own rate hikes as central banks in Europe and other parts of the world try to tame their own localized inflation. And
So
finally,
Ryan, can you
go ahead.
Maybe dive a little bit into inflation here, because we have a question in the chat that I'm totally understanding. I'm seeing this with it just regular life. I'm hearing it more and more. A lot of people know I'm involved in coaching soccer, and the costs for the teams for travel just going way up, the costs for food going way up. We all feel it at the grocery store. So the question is, can we talk a little bit more about inflation? When we talk about 4 to 9% inflation and we go to the store, we've seen food prices jump by 50 to 100% and more. And my wife, it seems like every week she mentions this, like every time I go to Costco, it is so insane. And the comment she always makes is, I don't know how everyone's making it by. Can you give us a feel for like, why is there that disconnect between what we talk about inflation and how we feel inflation, and any other opinions you guys may have about inflation?
Sure. So just to go back on my comment specifically about inflation a few slides back here, the takeaway here on inflation is that we made progress, and specifically the Federal Reserve has made progress. And that's not necessarily that we're doing a victory lap per se. It's just that it's down from the worst that it was in the past 40 or so years in 2022. And the reason it's doing better is because of the Fed's interest rate hikes and tighter monetary policy. That said, prices are not even in across all sectors of the economy. We had a real energy crisis in 2022 when war broke out in Ukraine, and with Russia's invasion of Ukraine, that challenged supplies. COVID-19 challenged supply routes. And what we've seen since 2022 and more recently is improvements significantly on those things. So, for example, the price of a shipping container has gone down dramatically, which results in cheaper shipping costs around the world. It allows businesses to be able to supply inventories more confidently and keep hiring, keep that going as well. We've seen energy plummet significantly as well. So the price per gallon of gas on the industrial scale peaked around $130 per barrel. I'm sorry, per gallon. I'm sorry, but I'm talking about crude oil, not gasoline. I'm sorry. So crude oil reached about $130 a barrel.
This part is
and
that you think we're all following you. You've lost us on that anyway.
I know, yeah. And crude oil has about halved that in 2023, down about 50% for a barrel of crude. So it's not widespread. Wages are still significantly elevated. I think Tim's going to get into some finer detail on where we're seeing some of this inflation still percolate. But the main takeaway, as what I was trying to say, is that we made progress. We haven't reached the victory circle. The Fed's not spiking the football, so to speak. We're really just encouraged that the Fed's rate hikes and tightening has brought down prices from their 40-year highs. So that's kind of what we're celebrating.
Ask you a clarifying question too, though. So it sounds like it's not just that the rate of inflation has gone down. In other words, it's not just that prices are going up at a slower pace. Some of the prices have actually come down, is what you're saying, in a few sectors. Is that right?
Correct. Yeah. And then if you think about inflation at 4%, that's still elevated from what the Federal Reserve wants to see. They want to see inflation come down to long-term 2%. That's their stated goal. So if you're still well above that, there's still, the fight's not quite over, but we're at least encouraged by the progress.
Okay.
So if I could add a quick comment, Zacc, because people are still feeling the pain. The CPI, the Consumer Price Index, is a basket of goods, and egg prices are down a lot relative to where they were. Milk has come in a bit, other soft commodities, other goods, not so much. Rent is still up tremendously year on year, right? So you can easily, to your wife's experience, pull out a couple things, and wow, the sticker shock is still beyond significant. The other thing, and if you're a politician, you can get dinged for this. You can say, boy, inflation's moderated to next to nothing month to month, and technically you would be right, but prices are still higher than they were before. So, if a loaf of bread goes up 3 to 4% on an annualized basis for 15 months in a row, right? That's meaningful, even if it then goes up 0.5% on an annualized basis month to month. So a lot of life comes down to sort of what side of any particular argument you're on. So inflation has moderated a lot. Even some prices are experiencing flat, if even a bit of deflation, but everything is still kind of up a lot. And I think that's why people are still rightly feeling it. And what's really tricky for a politician in power right now is wages have not kept up with the increase in the cost of goods and services, which means most Americans have gotten a pay cut the last year or two, because even if wages are up 3 or 4%, that dozen eggs costs 7 or 8% more. And that's the other reason why I think people are really feeling it. So even moderating inflation with still elevated prices, given how recent those prices have spiked, is still really hard on a lot of people. And there's still a lot of emotional and not just financial angst that goes with that kind of experience.
Right. Do you think that we should just buckle up for those prices to stay here and for the economy and wages to catch up? Or do you think that some of it might come back down?
I think some of it's going to come back down. And you have seen some of that. To Ryan's point, West Texas, which is the domestic benchmark, Brent is the global benchmark for crude, is 70. It's got a 70 handle on it, had 120, 130 handle not that long ago. So I do think a lot of that will cure itself, but some prices will not go back down to sort of pre-2020 levels. One of the best bits of advice I ever got when I first got into this business a long time ago was from someone who used to trade commodities. And that advice was, price always cures price. If farmers can make a ton of money selling corn, they're going to plant more corn, then there's going to be too much corn, and the price of corn will go down until they stop planting corn, and the price goes up and they start planting corn again. So as long as the powers that be don't mess with our economic model too much, because I think even with its imperfections, it's pretty darn impressive, a lot of this will solve for itself as the private sector provides goods and services to meet what has been unmet demand. So I think a lot of it will reset for sure. It's just going to take a while.
Got it. I like it.
Yeah, and just to put a final point on there, we'll circle back on some of this stuff as we have some remarks in the second half of the deck here too. So.
Yeah, and there's a question about the dollar. I think there are some slides coming, so we're gonna hold on that one as we talk about it here.
Okay. Just the final slide on your screen here before I hand it over to Tim just shows the S&P 500 when the benchmark climbs at least 10% to start the year through June. And you can see on the right column, performance over the next 6 months after that is still generally pretty positive. So even though we've had a strong start to the year, that doesn't mean that we should just call it a year and go back home and wait for the next year to start. There's plenty of reasons to be optimistic, and I think Tim will get into that shortly. So let me just.
Oh, Ryan, a quick story on this. I had a fellow advisor that I worked with at a previous firm, and his thought was, oh, will you mind throwing that slide back up because it goes along with that slide. His thought was, once we get a 10% rate of return, we should just sell everything in the portfolios and then just sit on it until the end of the year, and then January again buy it, and once we get a 10% rate of return, sell everything and sit on it. And like, look at what would have happened here if you did this. Over on the right side, that's a large majority of those instances in which you would be giving up a lot of return by implementing a strategy like that. Anyway, I thought this is such a good visualization as to why that would not be a good idea.
Yeah, we have some additional slides that are also really encouraging, such as when you get to the end of an interest rate hike cycle, history is on your side. When you get through on the other side of a recession, if we so happen to have one, returns are pretty strong. And then when you turn it over from a bull to bear market, bear to bull market, that can run for a very long time and last, years, if not even more, a decade. I think the last one lasted exactly a decade. So just calling it quits after 10%, you're leaving a lot behind if that's your strategy. All right, I'm going to kick it back to Tim with the slide share to him.
And so while he's doing that, Ryan and Tim, the question is, what are the long-term implications of de-dollarization and markets? So you probably saw that. You guys decide where exactly that fits in.
All right, so hopefully you see China's struggle, dollar remains on the front foot. Yes. Okay.
Yes, that's what we got.
Okay.
Yes.
Thank you. I appreciate it. So the dollar index on the right is off a 20-year high, but not meaningfully so. Lots of talk of global de-dollarization. I think there is some risk to that. I think what has started that conversation is some of the sanctions on Russia, right? The dollar is the world's reserve currency, and if you prevent people from doing business in the dollar and you print the dollar, that's a pretty powerful tool, but other countries are going to get a bit worried about that. And so I think, China's a little worried about that, Saudi Arabia. The dollar could always be displaced. Our opinion is if that does happen, that is so far down the pike, it probably won't mean anything to anyone on this call. Most financial transactions are conducted in dollars, even with companies that are not U.S. domiciled. And by far, more central banks hold more dollars than any other currency on the planet. And so, sorry, go ahead.
I was just going to ask you a question on what you said. Do you say that it won't mean anything to people on this call because you know that our audience is mere retirees? Or are you saying, like, I'm just trying to clarify here, or are you saying that because, like, even somebody who's in their 30s and 40s, it's that far away that it won't matter for them as well?
Even a 54-year-old like me, who is young at heart, I know I probably look like I'm 30 or 35. This is decades and decades away. In our opinion, in my opinion, the institutional advantages that the dollar has relative to any other currency are just almost too meaningful to enumerate. And with all of our problems as a country, Nassim Taleb, who's a very intelligent hedge fund manager who wrote a book called The Black Swan, coming out of 2008 and 2009, said, the time you should really worry about the dollar is when people are lined up at embassies for China and Russia and Iran around the world trying to emigrate to their countries. So yeah, again, it could happen, but in our opinion, if that were to happen, and we don't think it will, that day is decades away.
And without going too far into, we've talked cryptocurrency and things like that in the past, but
Yeah.
that's their big argument is that, hey, we're going to solve it through another, more mathematical based currency. But clearly that's been a really rough go for the last, let's call it 6 months to a year, maybe more.
Yeah.
And it almost felt like they had a reasonable argument for like, oh, maybe like the actual currency, the standard might change more rapidly than we anticipate. Yeah. But that feels like that's maybe been proven wrong over the last year. Like, is that true? Are we reading into this wrong? Like, what do you think?
No, I think it's interesting. Digital currencies rallied through the banking crisis as people wanted to sort of get their money out of the traditional banking system. And my personal opinion sort of lines up with some pretty prominent folks on Wall Street that there's efficacy to blockchain technology and all of that. But I think where I've always struggled with digital currencies and the idea that, say, Bitcoin will supplant the US dollar, and not to say it's right or wrong. If you look at what the SEC and Chairman Gensler are doing in the digital asset space, pretty much suing every player of any significance, picking a fight with the government's really, really a difficult thing to do. And so, if you're the US government, if you're the European Union, if you're the Bank of Japan, and you can print something out of thin air that is the medium of exchange on a global basis, and you happen to control, the military and the judicial apparatus and everything that goes with that, are you really going to let a distributed, decentralized digital currency usurp that, what the former French president once called the exorbitant privilege of printing the dollar? I mean,
Really
the
fair.
institutional interests are just so massive and so powerful. Again, not to get into that fight, that I would have a hard time seeing the powers that be go quietly into that good night and let Bitcoin take over.
Got it. Okay, that's great. Love it.
Yeah. So the three key questions for the second half: how real is recession risk? The banking crisis, is it past? Ryan touched on those 2 points already. And have we seen the lows for the cycle, for the market? Which might seem like a bit of a silly question, considering, as Ryan mentioned, we're up over 20%. But there are a lot of people that I think are still on the sidelines, didn't see this rally coming. And so I know we're already coming up on 5 o'clock. So I want to be sensitive to everyone's time. So I'll go through these three and we'll talk a little bit about.
Yeah,
Go ahead,
we're good in terms of timing. We're halfway through our hour block, so
Oh, good. Okay.
we're doing great on time.
Good.
So you have time, and let's cover it well. And we'll plan on wrapping up the webinar at 3:30 Mountain Time,
Sounds
and
good.
we have plenty of time.
Great. Thanks, Zacc. So I'll work
Mhm.
off of that 3:30 Mountain Time
Yeah,
stop. And then we'll talk a little bit about commercial real estate as well. So, even though this is the most predicted recession in the history of recessions and it hasn't shown up yet, we still think recession risk is very elevated, even with the very strong labor market that Ryan referenced earlier, even with a still pretty robust US consumer. And all we're doing on this slide is cutting and pasting some headlines around that recession question. To the economy's credit, it's proven to be remarkably resilient in the face of a Federal Reserve rate hiking campaign that's really unprecedented. The Fed's been around a little north of 100 years, give or take. Got founded in the 19 teens, way back when, and through 4 meetings during the current interest rate cycle, the Fed raised rates 75 basis points at all 4 meetings. They had never done that before. And even with all of that, the geopolitical headwinds, the sort of sour small business and consumer sentiment, the economy has really hung in there. But we continue to think that recession risk is high, and we're most likely going into some sort of mild recession into year end, if not early 2024. And we'll talk about why we think that's the case. Before we get into why we think we could or maybe still avoid a recession, just to define a recession, The official definition is laid out on the right-hand side of the slide. And that's something that the National Bureau of Economic Research has put together. It's a group of academics, really smart economists, and they look at all sorts of things to tell us when we're in a recession, including heavy emphasis on consumer spending and income. The tricky thing about the NBER is it tends to tell you you're in a recession only after you've exited a recession. And so far, at least, the NBER has not said we're in a recession. That could change, obviously, going forward. The unofficial definition is on the left, which is 2 consecutive quarters of negative GDP growth, which we actually experienced last year. Q2 and Q3 were negative 1% on an annualized basis. But again, the consumer was so strong last year and still is pretty strong that we don't think the NBER is going to say, even in hindsight, that was the downturn. But again, we're on recession watch, and we do think, all things being equal, one is coming.
Maybe also
wait,
and also it's just so funny to me because it's like one is coming, but that could also mean that the moment is coming in which the NBER will tell us that we were in a recession, right?
Yeah.
And then we'll sneak out of it and we'll be like, oh, that was a recession? Oh, okay, we're done.
No, that's a great point, right? So you had the S&P off, to Ryan's point, 25% peak to trough last year, about 18% for the calendar year, fixed income off 13%. You know, and maybe that negative 1% Q2, Q3 was the soft landing, right? Even within high inflation at the time, the Fed kind of stuck the soft landing, and in hindsight, we'll hear. So that's a really good point. And the NBER only does fly that recession flag with a lot of rearview mirror time under its belt. So we'll see, but that definitely could happen. Right. In terms of the business cycle itself, you know, we say there are 5 stages to a full business cycle, but we really repeat, you know, or focus on sort of peak to peak, and in between you've got contraction, trough, recovery, expansion. So there's a rinse and repeat dynamic to the business cycle. Some recessions are very severe, like 08, 09, 2020 was exceptionally sharp, but it was driven by a policy decision to shut down the economy. You know, our best guess is we're sort of over on the far right. You know, we're past the peak. GDP growth is moderating, employment gains are moderating, and that we're going into some sort of contraction. It doesn't have to be that severe. It doesn't have to be like 08 and 09. You only get those kinds of downturns when you tend to have some sort of bubble that pops along with a weakening economy. So housing 15 years ago, or the NASDAQ, the tech stocks, 20 years ago now. And so absent that, the downturn doesn't have to be severe, but we do think we're at real risk for one.
Hey, can I
go ahead.
Maybe mention something? I want to take, for those of you listening, go back one slide if you don't mind. I want to just show this cycle and explain something really quick about your exact portfolios. So for example, different portfolio managers specialize in different portions of the business cycle. So if you fire particular investment managers, and I'm not talking about Capita, I'm talking about the people that Capita and you decide to employ for decision-making in your portfolio. So let me give you an example. Poland Capital, I believe they will do better in recoveries and expansions because they focus a lot more on earnings growth and how strong the companies are, how much of a moat around their business they have. How well will that business do when things are booming and going really well? Whereas a firm like maybe Columbia, which looks for what's called pricing dislocation, where they're basically, that's a fancy way of saying what's on sale and shouldn't be. What's a good business that's maybe too far punished for just the market going down. They're going to find more opportunities through contraction in the trough, where they find that pricing has been mistakenly dropped too far, and then they do well throughout that trough and then beyond. Whereas maybe a company like Logan that really looks for long-term stable companies that pay high dividends, probably going to do better between the peak on the ride down to the trough. They're probably going to lose money still, like all of the market in general, but relative to the broad market, they will do a little better there. And we employ these different managers all within the portfolio together so that through the full business cycle, your portfolio does well. So be cautious of judging a portfolio manager for not performing well in the business cycle that we're not expecting them to perform well throughout. Hopefully that gives you a little bit of an idea of how to take what you're seeing here and apply it to your accounts.
Yeah, no, it's a wonderful point. Expectations and setting expectations. And yeah, to your point, sometimes as much as we all love great performance, sometimes if a manager is doing really well and to your point, Zacc, in a cycle that doesn't really line up with their style and strategy, you wonder if they're sort of coloring outside the lines.
Yeah, it's
A
almost a
little bit.
negative at that point,
Yeah,
right? You're like, wait a
yeah,
second, you're not supposed
yeah,
to be doing well right now. What's
yeah.
going on?
What's going on? No,
Yeah.
so that's a great point for sure. Okay, so on this slide we just lay out the bullet points for a recession happening later this year, maybe early 2024, and the next couple slides just sort of reinforce those points in visual form. And I won't go through all of them, and I've touched on one or two, but the Fed has raised rates aggressively and shrunk its balance sheet, which is another form of an interest rate increase, really tightening monetary policy. The bond market, the yield curve, is screaming recession, and just what that means is that yields on short-term instruments that the government sells to raise money are higher than longer-term instruments, which is kind of goofy, because if you're buying a long-dated bond from the government, if you're loaning money to, say, the U.S. government for a long period of time, you should demand a higher interest rate or yield, and so that only happens when a recession is coming. Leading economic indicators have weakened. All that extra money in the economy is slowly being drained out. That's an issue. CEO and small business confidence isn't great. I'm a big believer in sentiment. Sort of, when you feel good, you take your kids and your wife out to eat, and you maybe treat the family. And when you're a little nervous, you don't. You just don't spend money, and businesses operate the same way. The banking crisis, we think, is manageable, but it's made a recession more likely. And even the stalwart of this recovery, the labor market, is showing some signs of weakness. So just to kind of call out some of those points in, again, visual form, on the left-hand side is the amount of money in the economy and its rate of change year over year. And it spiked when the government pushed all that money into the economy during the pandemic. And now it's actually negative year over year. That money's coming out of the economy. And on the right-hand side, unemployment claims have moved up. Still low relative to history, but that's kind of a canary in the coal mine for the labor market and for the economy. Again, the yield curve on the left-hand side, again, whenever that blue line goes below zero, you tend to get a recession. And whenever you see those vertically shaded bars in this presentation, those are recessions. Now, it can take as much as 12 to 18 months before the yield curve inverts and you get a downturn. And the yield curve inverted about 8 months ago. So the clock is ticking, and we've never had an inversion, as you see on the right-hand side, to this extent without a recession of some extent. Small businesses are not feeling all that optimistic, which we call out on the right-hand side. So, recessions are rare. The U.S. economy has only been in recession about 10% of the time over the last 40 years. I think we all participate and help create this economic miracle that has done so much good, not just for America, but for the world, the U.S. economy. But they do happen. It's not a good bet to make because they are rare, but they do happen. And a lot of signs are pointing in that direction. That said, not to be one of those Wall Street folks that likes to have his cake and eat it too, but there are things holding the economy up. And we laid out those factors on this slide. The third bullet point, particularly important, the unemployment rate is still sub 4%. The bullet point above that, a lot of excess money still in the system, though it's slowly being spent down, all that largesse by the government and the Federal Reserve 2 years ago, 3 years ago. Housing has hung in there. This isn't 07, we think, because you just don't have the supply dynamic that you had 16 years ago. That was the tipping point for the Great Recession. Inflation is moderating, which is obviously good news for the economy and for the Fed. And as of now, the last bullet point's pretty interesting. There's a great data point that the Federal Reserve puts out on a real-time basis trying to track the economy. And its best guess is that Q2 GDP was up about 2.3%, and we'll get that real number soon. And on the right-hand side, that's just disposable income. And you see that massive spike coming out of the pandemic when the government really in an unprecedented fashion pushed $5 trillion into the economy. So again, we think on balance, even with these positives, the outlook isn't all that great for the US economy into 2024. That said, the economy and the markets are two different things. They're linked, but they're distinct. And we've been optimistic about the market, and so far, knock on wood, we've been right. And we think stocks can continue to do okay, even if the headlines get a bit unpleasant going forward. We'll spend a few minutes talking about the banking crisis and then the market and commercial real estate. And again, if you have any questions, please continue to send them in, or any comments you'd like us to respond to. More than happy to. We think, and it has faded from the headlines, that the banking crisis is more or less past. And again, we're going to lay out the case for that and then call out some visual points to support it. You had an unprecedented, almost regulatory response. What the government did, the three banks that failed were quickly taken over by bigger, better capitalized companies. The system is well capitalized. You go back to 08 and 09, lots of rule changes coming out of the Great Recession that forced banks to raise trillions of dollars and hold that money on their balance sheets. We do think individual banks could still be at risk. Commercial real estate is a problem there as well. But if you look across the banking system today, if you look at things like credit spreads and how bank bonds are trading and how the market's behaving, it doesn't seem like we're facing systemic risk. What happened was really idiosyncratic risk that happened at three specific institutions. So I don't know if you can have idiosyncratic and three in the same sentence, but that's kind of what happened.
Wait, so, Tim, I want to see if I can follow, because I connect the dots for us.
Yeah.
Is it commercial real estate being used less due to more work from home, a change in environment since COVID, and then the effect of that on the fact that banks have provided so much credit for the expansion of commercial real estate? And you put all that together with the fact that commercial real estate, between the day that they say they want to create a building to the day that they actually can rent it out, is such a long period of time.
Yeah.
Is that the dot that we need to be connecting? When you said it's commercial real estate could affect banks, is that the problem, or am I missing? Is there something else there that we're missing?
I think connecting commercial real estate to the banking system sort of on a go forward basis makes a ton of sense. And it's a point really worth making. I think what happened at Silicon and Signature and First Republic, those were the three that failed. Commercial real estate had a little bit to do with that, but it was more bank balance sheet management and interest rates going up quickly and depositors fleeing those institutions. Now, some of that dynamic that drove depositors to leave those three banks and take their money with them was tied to concerns about, say, Manhattan real estate and San Francisco real estate in the case of First Republic, Signature, and Silicon. But it's really more that the banking system is still under a little bit of stress. Urban office real estate in particular is struggling. And if there was something that was going to continue to weigh on the banking system going forward, I think it's I think it's that. I think it's urban core office properties, if that makes sense. So really what happened on a look back basis had a little bit to do with commercial real estate, but more had to do with the Fed jacking rates up so quickly and these banks really being caught flat-footed, their depositors becoming scared. And you kind of had, like you had in the great movie It's a Wonderful Life, a bank run. But instead of George Bailey being in the room and convincing everyone to stick with the Bailey Brothers building and loan, this played out on social media real time, and people just fled, and it became a self-fulfilling dynamic, if that makes sense.
And the depositors weren't just individuals. I mean, it was tech companies and large institutions that their concentration of customers was into very narrow set of clients. And so it wasn't like this broad diversified problem across many industries.
No.
It was a very narrow industry too, as
Yeah,
customers.
no, you're absolutely right. And the slide or the graph on the right-hand side of the slide is, I think, probably the most important visual that we've come across that kind of speaks to what happened, right? So Zach's absolutely right. Silicon Valley Bank, big presence in Silicon Valley, Northern California, the venture capital community. That was a tough place to be last year. Growth stocks got hit really hard as interest rates went up. Signature Bank in New York, big presence in the crypto space. And you could argue, not to get into that fight, that the regulators weren't crazy about that business. And then First Republic, kind of the worst of both worlds, sort of Northern California and Manhattan, high net worth footprints, and a lot of commercial business too. And so, you know, what those banks had in common, unfortunately, they wish they didn't have in common. And the biggest point, I think, is made on the right-hand side of the slide. And this gets back to Zach's point about not just individual depositors, but corporate depositors. Silicon Valley, Signature, and First Republic had 60 to 90% of their deposits in the uninsured bucket. So if memory serves, the FDIC, the Federal Deposit Insurance Corp, will insure deposits up to $250,000. Most Americans don't have $250,000 in the bank. They've got 5,000 or 500, whatever it may be. So they're not really worried about their deposits. Unfortunately, those three banks took in a tremendous amount of deposits north of 250, a lot of small business deposit relationships, commercial relationships, law firms, investment banking boutiques, things like that. And in theory, if there's a run on the bank, those deposits are not covered. And so once there started to be that concern that these banks could be at risk, those folks started to flee, right? And in an era of the smartphone, right, when you can bank on an app and move millions of dollars with the touch of a button, it all happened at lightning speed. So in hindsight, these three banks took in a tremendous amount of money in deposits, grew their balance sheets probably way too quickly, didn't hedge interest rate risk as the Fed was raising rates that made their fixed income portfolios worth less. Some of those banks had to sell bonds at a loss to raise money. Their depositors became concerned, and you just had this vicious cycle where things started to bleed out slowly and then all at once. And so that's not what the overall system looks like, but that's what happened with these three banks. Now with commercial real estate struggling a little bit, and a few banks probably with too much money in that uninsured bucket still, there is bank-specific risk, we think, still in the system. But because this was so specific to those three banks, or the characteristics of those three banks, we don't think this is systemic. It's not 08, 09. It's not a TARP program kind of situation, if that makes sense.
Okay, I like it.
Okay.
I do have one question I want to get to in a minute, but you keep maybe it's not related to this. So let's go through what you need to cover here, and then maybe tackle it has to do with artificial intelligence.
Yeah, and I'll jump ahead a little bit, but I want to call out the graph on the right-hand side. Banks are less willing to make loans right now. So because of the stress in the system, as you might imagine, lending departments are kind of pulling in their horns. So you could think of the banking crisis as almost a de facto rate increase. It's making it harder for companies to get access to capital, which is why we think, even though it's not systemic, it makes a recession a bit more likely. If you want, Zach, we can get into the AI question and then talk about the market and commercial real estate in the final 10 minutes or so.
Yeah, let's do it. Okay, so this is a really good question. For those of you who may not know, I've loved following all of the neat things you can do with artificial intelligence, but it also brings some really, really difficult questions, this being one of them. So I'm going to summarize what Sean here has asked for those who are on the call. Basically, the Google CEO talked about the need to address the technology industry around ethics and oversight of artificial intelligence. And the bottom line question is, do you see it as a disruptor in portfolio design? And do you see the day where artificial intelligence may be able to outperform humans who currently design and manage portfolios? While you think about the answer there, let me just tell you quickly, I had about a 40-step process that I needed documented at Capita for our other employees. This is just for everybody listening. There's AI called Scribe, and I just logged into Scribe, pushed a button, and started doing the process, and it automatically created step-by-step instructions with screenshots with little red circles where I clicked, and made me a PDF that I sent off to the rest of my team. That normally would have taken me hours to create that system and have somebody else sitting there with me to document it. And it just spit it out so fast. It was so great. So I've used it in many, many ways. I have yet to see its implications in portfolio design. I anticipate that it will, because it's changing the way marketing firms operate. It's changing the way we as a financial advisor firm operate. But okay, so with that, Tim, Ryan, what do you guys think?
Yeah, my quick answer would be, and at the risk of being flip, because I'm fascinated by it as well, but I'm no expert. History is chock full of technologies that were supposed to completely sort of knock us as humans sort of out of the economy, or at least make all sorts of people obsolete. You go back to buggy whip makers, and then the automobile comes along, or mechanized agriculture when 25% of the country used to be involved in agriculture 100 years ago, or the mainframe, or the semiconductor. So the optimist in me tells me that assuming there are some good guardrails around this, and hopefully there's a decent relationship between the private sector and the government, and maybe some third-party institutions to solve for this, that it'll be additive, it'll be accretive to economic growth and productivity. But where it gets tricky, especially for some of us older folks who are 54, even if we feel like we're 30, you have to keep running hard. You have to stay current, and that can be a challenge. But the optimist in me tells me this will be a good thing, and we need to see productivity go up, especially with some of the challenges we're dealing with on the demographic end of things as it concerns economic growth. So I'm going to fall out in the optimist camp.
I'm there as well. I think that most companies, we keep wondering, like, how could these businesses actually expand their profit margin? There's only so much you can do. The only thing you can do is grow the business and keep the same profit margin. And then something like AI comes along and changes how many employees you might need. I still think there are some sad aspects of it. I do think some jobs will go away. But I think the companies that embrace what technology exists and the companies that find ways to utilize it will do really well. I mentioned that PDF it created. It still required me to change probably 20% of the verbiage on the 40 slides it created. So I think that it will speed us up, but it won't completely replace. We'll still need people in there, and then we'll still need people to communicate. I know that they have AI to communicate with people, but right now we're still a long ways off before people completely trust computers over humans to help them make decisions. But I do think some of that will aid the decision-making process and efficiencies by a lot. The ethics consideration, a whole different ballgame as to what should be available, and that will need some addressing, but I don't have an opinion on that yet. I'm the same way as you, Tim. I'm excited about what it can do to help. I'm a little nervous about what ethical questions need to be addressed.
For sure. Yeah, no, I think well said. Go ahead, Ryan.
And then specific to our industry, Zacc, I think whoever just on board and says, I'm just going to use AI for investing or something, so to speak, and if something goes wrong, you only have yourself to kind of look at for any guidance there. If the mistake is made and you're left behind, you're just looking at yourself for an answer there. And then the other thing is, over the past 20 years since the dawn of the internet, everyone kind of assumed that with all this real-time data available to retail investors, that who needs a money manager anymore, who needs a financial advisor anymore. And we still find year after year that folks just make behavioral mistakes and get caught up in emotional decisions that can be avoided.
That makes sense. Okay, so we have 5 minutes left. I love it. This has been so good. Why don't you give us your most important points? We'll put some contact information at the end of the PowerPoint up for the last minute, and that way people know how to reach us if they're not already in contact with us through their normal channels. Sound okay?
That sounds great. I'll go this slide and then two more. I'll jump forward. So we think we've seen the lows for the cycle. Late 02 was awful. sentiment valuation got very attractive. Inflation's rolling over, bond yields have peaked. We have a lot of other things going for us. So nothing goes up in a straight line, but we're in a new bull market, and we think we have seen the lows for the cycle. And not only do you get a good second half, typically when you've had a good first half, typically stocks don't go down 2 years in a row. And last year was awful. And I'll call out this slide super fast. On the right-hand side, the S&P was off 18%. Last year, Q1, we were up about 8. You see a lot of green and not so much red. And rarely do you see red back to back outside of a terrible recession. So, you know, we think we're in pretty good shape. In terms of commercial real estate, we think it's a shoe that's about to drop. But as I've been joking, it's not a Shaquille O'Neal size 25 shoe. It's more like a Grace Holland, my daughter, size 7 shoe. So there will be pain from it. Downtown Chicago, downtown San Francisco, Midtown Manhattan. Other cities are doing great. Other states are doing great. So again, we don't think it's systemic. And we would call something out about commercial real estate because there have been lots of scary headlines. If you look on the right-hand side, and Zacc rightly touched on this, urban office is really struggling again in those cities I already mentioned and a few others. But commercial real estate is much more than just office. So office space is about 17%, multifamily, apartments, industrial, healthcare, those are all big buckets in an important part of the economy that includes but also transcends urban office. And again, not all urban office markets are the same. So we expect some pain. We expect it to be bank specific. And if those banks have balance sheets and deposit bases that are a bit tricky right now, that could put them into that unfortunate territory that already includes First Republic and Signature and Silicon. So circling back, recession risk is real. We do think the banking crisis is past, but you could have another bank or two find itself on the wrong side of history. We think those lows are in for the market. We've been feeling pretty good about stocks, and so far so good, knock on wood. And again, commercial real estate will continue to weigh on certain banks in certain markets, but only as it concerns specifically, we think, urban office and not the broader asset class. And then finally, to leave you with this thought, the market isn't the economy isn't the market. You know, even if we start to see some unpleasant headlines into year end, and we think we will, we think the jobs market will get a bit softer. It doesn't mean the market can't continue to move up and to the right. And all we're doing here is calling out across the last 3 recessions, the early 2000s, the Great Recession, and then the pandemic-driven downturn. While the headlines were screaming recession, the markets had already found their footing, which we've already seen, knock on wood, and we're grinding higher. So important to remember, the market and the economy are linked, but they're distinct. So I'll stop there, Zacc, and hand it back to you. And thank you all again for your time and for the questions and the comments. They were awesome.
Yeah, of course. We have really smart clients that
For
focus
sure.
on this stuff really well. We're happy that you guys joined us, and I'll put contact information up here really quick. And hopefully, you know, your questions have been answered. You guys probably know any questions that you may have, for sure, reach out to us afterwards, and we're happy to help as well. Anything else that comes through, I'll take a look at. I think actually I'm probably going to pass on the sharing on my screen because everything just went dark for me. So we'll wrap up there.
That's probably because I hit a button I should have hit. So
That was probably
most likely was not your fault or
Nah,
Ryan's
Tim,
fault.
I don't think
managed
so.
to shut down your PC from way over here.
Zacc. That
far
was
you-
AI. That was AI deciding that you were done.
Apparently we are done. You know how to get a hold of us, folks. Call us if you have questions. I'm looking through. I do have a little bit back now. It doesn't look like we have anything else going on. But again, thank you for joining. We're right at time. Tim, Ryan, thank you so much. You guys are wonderful. It's so clear.
Thanks,
and a really good format today. Thank you.
Thanks so much.
Appreciate
Take
the
care,
time.
everybody.
Thank you. Bye-bye.
See you.
Bye.